Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. On today's show, we brought on a special guest, Matthew Sullivan. Matthew is the CEO and founder of QuantmRE, a company that solves a real problem for homeowners by helping them access a portion of their home equity without taking on any debt. Matthew, welcome to the show.
Mark, thank you for having me on.
So it's no secret that a majority of Americans, home equity is their largest asset.
Yes.
And even though it's their largest asset, as a financial planner, I rarely factor it in when I create a financial plan for someone because they need somewhere to live. They usually don't want to move. And there aren't that many options to get equity or get access to that equity that they have. There's reverse mortgages. And even though the product itself has gotten a little better recently, it still has such a bad rap that people just immediately dismiss it.
Yeah.
So I'm looking forward to today's topic of home equity contracts,
Sure.
Which can be an alternative way of accessing the equity in your house, and also looking forward to talking about it as a potential alternative investment for investors as well. So yeah, really looking forward to it. Maybe you can start us off by telling us a little bit about how you came to start QuantmRE and what a home equity contract actually is.
Sure. Well, in reverse order, a home equity contract or a home equity agreement is a way for a homeowner to access some of the equity in their home, but without having to take on more debt. So what you were talking about before, the instruments like a reverse mortgage or a home equity line of credit, those are all debt products. And if you look at the commercial real estate world, there are any number of different ways of raising capital that combine debt and equity. So you have senior debt and junior debt and mezzanine finance, which is a bit of debt and a bit of equity. Then there's preferred equity, and then there's equity, and then there's shared appreciation mortgages. So for commercial borrowers or for commercial developers, there's a whole range of different ways of funding that real estate. For a residential homeowner, their options are severely limited, and they tend to focus entirely on the debt side. So you can have a mortgage or a home equity line of credit or a reverse mortgage, and that's kind of it. So what we're doing is we are bringing commercial types of funding to the residential homeowner. And so these types of funding structures have been around for decades, and a home equity agreement that has been designed for a homeowner has again been around for a number of years, but has only recently got the sort of momentum and the take-up that allows it to bring it into the spotlight, as it were. And to answer your other question, I came across this structure about 4 years ago. So QuantmRE is just coming up to 4 years old. And I stumbled across this concept of unlocking home equity without the sort of debt attachment, probably about 6 or 7 years ago at a crowdfunding conference. And it's a really interesting concept. It just fascinated me from the very beginning because it is such a large potential marketplace, solves such a major problem for homeowners who cannot borrow money or simply don't want to borrow money.
Can you walk us through a scenario where someone would use this, and then how actually does it work? Like, what are the steps from them deciding that they want to pursue it to them actually getting access to that equity?
Sure. And again, just coming back to what you were saying earlier about when you look at a homeowner's wealth, you don't take into account their home equity, which is sort of ironic in some respects because for most people, that's their largest asset.
Right.
And it is, really for, I think the number is something like 70+% of people have the bulk of their wealth tied up in their home equity. And the reason, obviously, you don't take that into account is because the only way of accessing it is, as you said, you sell your home or you start layering up the debt.
Right.
So for a financial advisor, it's probably not great advice to say, I think you should go out and borrow a ton of money based on your home. This, again, is something that is very different to a loan. So to answer your question, it's worth framing it by saying this really is not a debt product. It's something completely different. It is based on the way that we get paid. We're investors. So the way that we get paid is based on how much your house goes up in value. So we invest in the potential for your home to increase in value, and we take a share of that appreciation. So we get paid very differently to the way that a lender gets paid. So because of that, our risk is different, and we are, paid on if your house goes up, but on the other side, we also run the risk of possibly not getting paid or losing money even if your house falls in value. So your question really is, what sort of scenarios would this work in? And really, there are certain minimums. So you have to have a certain amount of equity in your home, and you need to be left with a certain amount of equity after our transaction. And the way it works is very similar to an option agreement. So we don't take any ownership of the home. It doesn't trigger any due on sale clauses or any property tax revaluation because it sits outside of the ownership. And it's really a promise by you to share in some of the future value of your home when you sell it in exchange for a cash lump sum today. Now, the cash lump sum can be up to $500,000 if you've got enough equity. The minimum investment is around $30,000. And then we have other figures like the maximum investment that we'll make is between sort of 25 and 30% of the value of your home, depending on where you are. And if you add that to your existing mortgage, then we have this concept of a combined lien to value. So if you add your mortgage to our investment, that mustn't be more than 75% of the current value of your home. So there's a few sort of goalposts where if you fall within the goalpost, then we are able to make you an offer. If not, then this type of program wouldn't work.
So let's use a scenario. Let's say someone owns a home. It's valued at $600,000. Let's just make it simple and say there's no mortgage on it.
Yep.
They own it free and clear, and they decide they want to come to you for that ability to access some of the equity in there. Are you offering something off of that $600,000, or are you offering something on the potential growth of that house going forward?
A bit of both, actually. So what we say is, and I'll give you an example of the agreements that we work with, it's effectively a discounted trade, to put it very simply. So what we say is if you want to access 10% of the current value of your home, which is $60,000, then you agree with us that when you sell your home, which can be any time in the next 10 years, and in fact, some of these agreements can run for up to 30 years, you will pay us 16% of the value of your home at the time that you sell it. Now, you can sell it at any time without restriction. You can also buy the agreement back at any time without restriction. That scenario, we would use an appraiser typically to value the home at the time that you bought the agreement back. So really, it's a discounted sale of the future value of your home, where you sell us 16% of the future value of your home in exchange for cash today, representing 10% of the current value.
Is there any difference if they sell their home next year versus 10 years?
Yes, and I'm really pleased you asked that, because obviously it wouldn't be very fair if someone received an investment from us and then 6 months later sold their home. So what we do is we cap the maximum amount that we can earn on that agreement to 18% each year. So in other words, if your property skyrockets in value, then the amount that we can make as a return on our investment is capped. And that's an annual cap. So that's calculated every month. So it's on a pro rata basis. So that means if you sold within 6 months, for example, you would only pay 6 months worth of that return cap. Now, it's not an interest rate. It just means that whatever we said we were going to get, we cap the maximum return at that figure.
And then what happens in the scenario where the homeowner says, well, I want to do a renovation project. I want to add another room, this and that. And all of a sudden they put in $100,000. And maybe it doesn't increase the value by $100,000, but they're adding money. Is that somehow factored into the agreement at all? Or
yes, it is. And again, it's very important to look at this because there are some agreements out there that don't factor that in. The agreements that we have will take that into account and say, if you're using the money that we invest, or if you force the appreciation of your home based on your investment, then as long as it's a material investment, in other words, it's not just, painting the exterior, for example. If it's a material investment and you can quantify that, and it can be validated by a third party, such as an appraiser, then we will strip out that extra increased appreciation that's due to your investment from the overall calculation. So that means that you get the full benefit of the increased valuation that you bring. Now, there are a number of different home equity agreements provided by different companies in the US. Now, that's not the same with all of those agreements. Or the beginnings of differences and different value adds in different programs. So it's an exciting thing to see how these programs are developing and different benefits to different types of borrowers or investees or homeowners is emerging.
You mentioned these agreements can go up to 10 years, maybe even 30 years. What happens if the homeowner decides they don't want to sell within whatever the length of the agreement is? Is there some kind of formula that's used then to calculate what your return will be, and then it's up to them now to figure out how to pay that back?
Exactly. And that's one of the real benefits of this is you don't have to sell your home. You do have to settle the agreement when it becomes due. We do want our return either at 10 years or 20 or 30 years, whatever whatever the agreement says. But you can buy this agreement back. In other words, you can refinance this agreement at any time without penalty. So there are no early payment penalties. You're not locked into this for a period of time. You can buy us back. Now, the way that works is because everything is based on the value of the home at the time that the contract is either concluded by a sale or by you deciding to buy it back. If you don't want to sell your home, we will send a third-party appraiser out, and they will calculate the value of the home at that point, and we'll use that to figure out how much it's gone up and what the percentage share is due to us.
What happens if the home actually doesn't appreciate? What if the value of the home goes down over time?
Well, there's, again, two scenarios there. If it doesn't appreciate, for the investor, there's still a little bit of upside built into the contract because, remember, we're buying a bigger chunk of the value of the home for a lower amount of money. So there's some inbuilt appreciation within the agreement itself. So that's what makes it attractive to investors. So, it's got to work for both sides. So it's good for the homeowner because they get a lump sum, which is tax deferred, and we can talk about that in a bit. And they'd have no monthly payments ever during the term of the agreement. So for the investor, there's a little bit of built-in cushion or in the money element, as it were, for that particular agreement. If the property significantly falls, now that means it needs to go down by 35, 40% or more, then there is the risk that the investor can lose money if the homeowner sells the home at that lower price. Now, the homeowner isn't allowed to buy us out at a discount. We've learned that the hard way. So in other words, the agreement says that if your property has significantly depreciated through no fault of your own, in other words, if it's the market conditions that's forcing that, not the fact that you've decided to, remove one of your walls, and it's a bona fide sale, then we will take the potential loss. But you can't refinance at a loss because that's sort of gaming the system, and that doesn't work for our investors.
How do you determine which house or type of house qualifies for this program? Do you look at it and say, oh, we think this is overvalued, or is it just some certain characteristics that the property and the homeowner has, and then you'll say, yes, this is eligible? I know you mentioned earlier about there has to be a certain equity percentage and a certain amount of equity percentage left after the transaction, but what else do you look for when you determine whether you're going to take a property on or not?
Primarily, it's the geography. So in other words, where is the property? So if the property is in a major MSA where it's relatively easy to price the property today, then that's a check in the box. If it's a rural property and it's expensive or it's difficult to price, then those are normally not within our investment purview, as it were. So normally we invest almost by exception. So in other words, we assume that your property will qualify if it's in a major MSA, if it's within our investment guidelines. In other words, minimum property value about $150,000 maximum about 5 million. We don't want to go over that figure because it becomes increasingly difficult to value these higher value homes where you could have 3 appraisals with 3 vastly differing valuations. So first of all, is it within the pricing guidelines? Secondly, are you in an area where there are lots of other houses, which makes it relatively straightforward to value your home? Thirdly, is your home in a good state of repair? Now, by good, it can be, C3, for example. That doesn't necessarily mean it doesn't have to be perfect, but we will accept or turn down properties if they're in a very poor state of repair. So in other words, we assume the answer is yes, we will invest, but if you happen to have one of those properties that is in a really poor condition and is likely to continue to deteriorate, then we will probably turn that down. But that's probably like a 1 in 50 scenario.
Does it have to be an owner-occupied property, or can it be an investment property as well?
No, and this is the great thing. So for landlords, typically people with small portfolio, it's a great way of accessing the capital in those properties because many landlords may have had their properties for a number of years where the tenants are busy helping them pay down the mortgage and they're really waiting for the payoff, which is when they sell the property. But in the meantime, I think as we all know as landlords, the cash flow never really materializes after, all the costs and the toilets, tenants, termites and trash, I think the 4 T's. So this is a great way for holiday let owners or, landlords to access some of the equity in their home, which they can then use for any purpose. Many use it to put down as a down payment on other properties.
Do you look at the credit worthiness of the homeowner or of the landlord at all? Because I think about, okay, what are other ways to access equity? And you have like a home equity line or refinance. Both of those, they're going to look at the homeowner. And do you do something similar on your side?
Yeah, we do. But again, we're looking at it through a different lens. So from a lender's perspective, you're looking at a credit report on the basis that we're going to be increasing your leverage or increasing your debt. Are you going to be able to afford this additional debt? First of all, that's more like a debt to income ratio question. Secondly, what's your behavior as a borrower? Do you pay your bills on time? Are you likely to be able to pay this additional loan? Now, we do look at credit reports because credit reports are an indication of what's happened in the past and almost a bit of a clue as to what's likely to happen in the future. So our minimum credit score is around 550. So it's much lower than you would see with a HELOC or a mortgage. But we still need to have some comfort that you're going to be able to pay your mortgage and your property taxes and maintain the property. So, we do look at credit reports, but really just to make sure that you're likely to maintain the status quo. Having said that, there are exceptions to that. And we have worked with properties where the homeowner has had a much lower credit score, but they had a much higher percentage of equity in the property. So there's more coverage there for us. So we can take more of a risk because we're unlikely to lose money if the property goes into foreclosure, for example.
And I know that it probably varies, but what's a typical timeline from when someone starts the process to when they actually have that lump sum of money in their hands?
Usually 4 weeks, but right now there's a fair amount of pressure on appraisers generally and the third-party service providers that we need to use, like the cities, for example, for recording the liens on title, because the home equity agreement is protected, or there's a cloud on title that goes along with that agreement. So those third-party processes, which we don't have control of, but need to happen, are taking a little bit longer. So today we're looking at around 6 weeks as an average, but normally it's closer to 3 to 4 weeks.
And so I know the scenario we used earlier was when someone owned their property free and clear, but let's go back to the one where someone has a mortgage on it. They're still able to participate in this program, correct?
Yes, absolutely. Because again, we're looking at that combined lien to value idea. So if they wanted to unlock access, let's say 10% of the value of their home, then as long as their mortgage is less than 65% of the current value of their home. If we add those two numbers together, 65 plus 10 is 75. So that means that it's below or at or below that 75% combined lien to value threshold. So someone who has a mortgage can still, because I would say 95% of our customers have mortgages. Very, very few people own their homes free and clear. And so, even particularly recently, because home prices have appreciated so much, the amount of equity that people have has increased significantly. So the mortgage, even though last year or a couple of years ago seemed quite a lot, now as a percentage of the value of the home, it seems a lot more manageable.
So, all right, let's take a step back. And we've been talking about this so far through the lens of someone accessing equity in their home. Now, as far as your company and the program, are you funding all these yourself, or do you have investors who actually can participate in the investment aspect of this side of it?
Well, we originate home equity agreements for investors. So we don't take capital risk ourselves. We are in the process of delivering a platform that will enable smaller investors, in other words, non-accredited investors ultimately, to buy into these home equity agreements. So a home equity agreement, when we write one of these contracts, it has a return profile. So there's an obligation on the part of the homeowner. It's not a debt obligation, but it's still a promise to do something in exchange for the cash that they've received. Now, there's a return profile which creates a real estate asset. In other words, it's secured by a lien on their title or a lien on their property. So it's a secured investment that has a return that is articulated in the agreement. So it has some value. Now, at the moment, we're originating those for other investors. What we plan to do very soon in the next few weeks is take each one of those home equity agreements and, using some pretty clever blockchain technologies, chop each one of those agreements up into lots of little pieces. And then smaller investors can then buy fractions of a home equity agreement. So you'll be able to go onto our platform and look at a number of these different home equity agreements in different areas and say, okay, I've got a couple of $1,000s to invest. I see that this agreement gives me this potential return based on houses going up 3% a year. So I'll put $500 into that one, $500 into that one. And so you're buying into a fraction of that agreement. And then what happens is it sits there. It doesn't generate any cash. So it's not like there's no yield. But when the homeowner sells their property, or if they buy the agreement back, the cash flows down to you. So you get bought out, hopefully at a premium at that point. In addition to that, we're planning to enable you to be able to trade or sell your interests in the same platform. So we're creating what will become a marketplace where people can buy and sell these fractionalized interests in the equity in homes that are not for sale. So it's a great way of enabling you to get exposure to equity appreciation in all of those properties where the homeowners simply don't want to sell. They're not rental properties. They are owned, and many of them are occupied by the owners. So they're managed by the best steward you can think of, which is the owner of the property.
So in that case, I guess a couple things. So one, like the ability for the smaller investors, that's almost like a Fundrise or some kind of crowdfunding.
Yeah, very similar. So it's exactly the same sort of concept of enabling people who don't have hugely deep pockets to be able to buy into the same types of agreements that are normally reserved for hedge funds, family offices, and institutions. Exactly the same crowdfunding idea. The big difference is that we intend to make it tradable on both sides. So with all of the crowdfunding, or with most of the crowdfunding platforms, you're buying into something and then you get paid out when that property is sold, or when that sponsor refinances your capital. So you don't have the ability to sort of trade your fractions. So that's the big leap forward for us, apart from the fact that we're making this asset class available through a home equity agreement, and that currently hasn't been done before. So there's a number of things that we are acting as the pathfinder on, as it were.
Being able to trade your investment, definitely being interesting, definitely being valuable. How do you envision the valuation of that? So like if I have stock in Apple, I can see what it's worth instantly, being that it's traded on exchange. You have, with real estate contract or an agreement, it's not as liquid and the pricing is not as readily available. How do you see that working?
Pricing is different. So on a stock, the price is really just the function of buyers and sellers. If there are more buyers than sellers, the price goes up. If there are more sellers than buyers, assuming that there's no other information available, that's what drives the price. It's literally the supply-demand calculation. Real estate's slightly different because even though it's still driven by supply and demand, you've got third-party valuations. Now, a home equity agreement's return is directly proportionate to the value of the home. So if we know what the home is worth, then we can instantly calculate the value at that time of the home equity agreement, because one is a direct coefficient of the other. So there's no sort of gray area there. So the great thing about residential homes in the areas where we invest is that there's a lot of information that's available as to what the value of that home is. So think of people like Zillow and House Canary and CoreLogic, huge companies that provide enormous amounts of information that's updated daily on what houses are worth. So what we know the value of the home when we go into the agreement, because we have that third-party appraisal. So we know that that's our datum point, the beginning. We know what that value is. What we need to do is track the change in value over the period of the agreement. And we do that monthly by using third parties, again, such as House Canary and CoreLogic as examples. For us, understand what the net asset value of that agreement is, and therefore your share of that agreement. What we need to do is figure out how much that property has gone up or down over the last month. So what we do is we mark all of our agreements to market every month. Now, you can decide as an owner of some of those fractions what you want to sell your fractions at. So the net asset value is only a guide, because obviously we don't really know what the property is going to be sold for to the 9th decimal point until it's actually sold. But we have a very, very good indication of what the property is worth. But again, you are free to buy or sell those fractions at a price of your choosing.
And I know you mentioned that this is upcoming and it's really for the smaller investor. You also mentioned the accredited investor. Is QuantmRE currently coming up with these agreements and then somewhat like securitizing? They're making up funds that accredited investors can invest in?
We're in the process of that, but it's interesting to know that actually one of the companies that is in the space, called Point, had announced the first securitization of home equity investments, as they refer to them, last week. So that was I think it was October the 12th, and that was $146 million worth of home equity investments or home equity agreements were securitized. So we're seeing an industry grow from a concept to the beginnings of institutional acceptance to securitization. So it is following the path of some very successful home-based financial products, such as mortgages, where those are packaged and sold every day. But to answer your question, we do work with a small number of accredited investors. Right now, our plan is to significantly expand that over the coming weeks.
What do you see as upcoming in the industry? I mean, I know you mentioned that we got the securitization, the smaller changes. What about from the homeowner side? Are there any changes you see upcoming in terms of how they can access the equity or anything?
Well, no, I think really just this. I mean, to give you an idea of the scale, the amount of equity in residential homes in the US is over $23 trillion. The number of homeowners who have 50% or more equity is over 18 million homes. So it's a very, very large asset class. It is completely different to debt. So all of that is in addition to all of the mortgages that are out there. So this doesn't compete just to a certain extent. So I think what we're going to see is more and more money coming in from similar institutions that have invested in mortgage products, because they're getting access to that same asset class, which is residential real estate. And again, we saw an announcement a few weeks ago that one of our other companies in the space had received capital commitments of $1 billion to invest in home equity agreements. So that would have been unheard of a year or 2 years ago. So we're going to see a lot more money coming into this space. It's a really interesting space because it solves a major problem for homeowners. That's the biggest thing that is driving all of this. In other words, it could be a really cool product, but if it doesn't solve a problem, it's not going to go anywhere. But this really solves a problem for homeowners. Coming back to your original point, this is a way of accessing the equity that they have, unlocking their major asset, which they can then put to work in other types of investment classes. I mean, imagine people with tons of home equity can now access some of that without debt, without the fear of missing a monthly payment, and they can put that into other instruments, perhaps that generate cash flow, or they can solve their day-to-day problems. They can repair their credit. They can then become eligible to borrow money, whereas before they weren't. So it's a really interesting product because it solves so many immediate problems. And most importantly, there is now significant institutional demand. So put those things together, and I think we're at a point where we're going to see some significant increased interest in this product over the next 2 to 5 years.
One thing I wanted to go back to, you mentioned on the investment side of it, potentially using blockchain. Is that to really kind of have like a central repository of all these different agreements and who owns what, and that eliminates really the need for like a custodian or someone that's keeping track of all this?
Yes, I mean, what it does is it creates visibility. So if you're buying fractions of something, from a technological perspective, it's actually a really good technology to use because it's very scalable, it's very light, it's very cost effective, and it allows you to keep track. Blockchain effectively, as we all know, is a distributed ledger technology, keyword being ledger. So we use blockchain in its truest sense, really, to keep track of all of these tiny transactions as they, as these fragments move from owner to owner. Now, we do that in a way that is also available to be viewed by the public. Now, you can't tell who the buyer and who the seller is unless you're good at, interpreting 128-bit, encryption code, which not many of us are. But those are anonymous in terms of you can't tell who's bought and who's sold. But what it does do is it builds confidence because people can see this audit trail of all of these different transactions. And that's also very good from a securities law perspective, because we need to be able to do that to be able to trade these securities in a compliant way. So blockchain really helps us get to market quicker, more cost effectively, and in a way that generates trust. And also from a trading perspective, as more and more exchanges appear that are allowed to trade securities, that means the number of venues where you can potentially buy or sell these home equity agreements will increase. So the overall marketplace and the overall landscape is increasing in size as well.
Yeah, I definitely could see that being exciting. So we're just about out of time. Matthew, I'd like to thank you for being on the show. You gave some great information about a potentially really exciting new real estate asset class.
Thank you.
How best can someone reach out to you if they'd like to find out more information about you or home equity agreements? Where can they reach you?
Well, everything is on our website, which is QuantmRE, QuantmRE.com. So we have a calculator there where you can put your property address in and we'll give you an estimate of how much we could unlock for you. We have an ebook that you can download that describes how these work. There's lots of video and podcast episodes there. So if you want to lose the will to live, you can listen to me again over and over, which I think is probably more of a cure for insomnia than anything else. But no, so all of it's there. And we have obviously people there at the end of the phone who would be delighted to answer any questions that you might have.
Great. We'll link to all that on the show notes. And thank you, everyone, for tuning in today.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.